Well, hey there, everyone. Happy Tuesday, February 10th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of beautifully sunny and clear 50-degree day here in Redmond, Washington. Hope you guys are all doing well. I am finally thawed out after a long trip to the Midwest and the East Coast. Good to be back home here, although it was awesome to see family and travel around a bit. But great to be back here in the Pacific Northwest. Great to be following these markets with you guys, as always. Today, we're going to talk about sort of a risk-off feel to the tape. Yesterday was a pretty encouraging day with a nice rally and the major averages kind of having a position of strength. Today, it felt like the longer the market was open, the longer it was going to go down, right? This is one of those, I always compare it to like a football game where it's like halftime, your team's down, and you realize you just need, it's like the first half, and you realize like this team just needs to get off the field and get back to the locker room and regroup. Like the longer this goes, nothing good's going to happen, right? It's not happening. This is what it felt like, right? It's sort of the first half of the day was pretty good, but by the end, the second half of today's session sort of got worse and worse. And some of the earlier gains you saw in growthy sectors, like some of the chip makers, all fizzling. And by the end, sort of a full run to the exit. So the market, in many ways, saved by the bell here as 4 p.m. Eastern brought the pain to a close. The Dow was slightly higher, but the S&P and the NASDAQ both down on the day. So not horrible days, kind of mixed more than anything, but defensive sectors at the top of the list. And that was what caught my eye immediately as I'm watching things progress through the course of the day today. Utilities and real estate were number one and number two. It's been a while since we've seen that particular configuration with big time defense, in a position of strength on a relative basis. We'll talk about that resurgence in defensive sectors. We'll talk about bonds rallying today in a sort of a risk-off move after today's retail numbers. And we'll focus on some earnings. We're sort of through the bulk of earnings season, but we still have quite a few S&P 500 names reporting this week. A number of names that reported before the open, including Marriott, which I'm kicking myself. I didn't pick that in that Super Bowl stock picking exercise we had over the weekend with Tom Boley and Grayson Rose. Darn it. I had Marriott on my list and didn't pick it. And I even made a point of saying, I'm not going to pick Marriott or Hilton, but I'm looking at those charts. Gar, should have done it. Up 8% today. Hey, whatever. Let's keep going here. Today, as always, we're going to follow the normal routine of the show. We're going to look at the update on the major indexes and major asset classes today, just make some comments on what moved and what happened. We're going to look at the heat map and look at sort of sector and individual stock themes. And then we'll talk about some individual charts that I've hand selected. As always, if any questions come to your mind as you're watching the show, please take a moment and drop it in the comments section on our YouTube channel. We've already had some really good questions so far this week, which I've already grabbed for this Friday's all mailbag episode. And we'd love to answer one of your questions on the show. And hey, thanks so much for watching. All right. S&P 500 finishing down 0.33%. That's 7,000 levels. Still not happening. Right out of the open, first 30 minutes, we did push briefly above 69.80. It felt like maybe this was the day, but it wasn't to be had. That ended up being the highs of the day around 10:30 a.m. Eastern. Everything after that was a downside rotation. By the way, in the little preview chart here, a 2-day chart I find super helpful just for recognizing what's happening today and relating that to yesterday. That is a common technique. A lot of traders that I've worked with, we keep an eye on yesterday's close exactly for reasons like this. The previous day's close often serves as kind of a pivot point for the next day. So just understanding where we're at relative to those the previous close, because that's an anchor point, right? We're all kind of anchored to yesterday's close. We're looking at percentage returns. We're looking to see if the market's up or down on the day, which means yesterday's close matters, which means more often than not, you'll get a bit of a reversal when we reapproach the previous day's close. And if we finally break through it, as we did early afternoon today, that usually means it's going to get uglier, as it did. And the last 30 minutes really accelerated to the downside. Last hour really from 3 p.m. on was pretty rough. So the S&P closes just below 69.42. That's down about 0.33%. That's not too bad of a day. The NASDAQ composite down more, down about 0.6%. The Dow still above 50,000 and actually ended up slightly higher. Mid caps and small caps essentially flat for the day. Volatility increased a little bit. Yesterday we got down to around 17. and finished around 17 and a quarter, a little higher, 1740. Today pushed a little bit higher as well as stocks rolled over. The VIX got not quite to 18, but sort of teasing that level. So volatility where it's at basically means market's not pricing in very significant moves in the S&P 500. And that's indeed what we found today. Bonds rallied today. This is the TLT. You can see it's up about 1.2%. So as stocks went kind of risk off, bonds rallied and went risk off as well. So bond prices going higher, yields came down. So the 10-year yield's below 4.15 at the close. The long bond yield now below 4.8%. The 5-year point right around 3.7%. So bonds rallying today, and that's sort of a reaction to this morning's economic data. So we had the retail sales numbers coming in a little weaker than expected. And what that means is basically the market, basically pricing in expectations for rate cuts this year. Market's pricing in 2 rate cuts and maybe 3 now. And that's what you're seeing with bonds rallying. And that's what the futures market would tell you. If you look at the Fed funds futures, might talk about that later this week if I can remember to do so. But for now, just note that bonds are going higher. And what that's doing is actually making the yield curve a little flatter. And the 10-year yield, potentially breaking support. I did grab a chart of the 10-year Treasury yield. We haven't looked at that in a little while, so I'll do so. The dollar index, by the way, was flat for the day today. Gold and silver both drifted lower. The GILD was down about 1% after yesterday's decent up day. Silver also had a great day yesterday, down about 3.5% today. While equities are in a low volatility mode, I would say precious metals very much not in a low volatility mode. This is in a high volatility environment, big swings in gold and especially in silver. You can see how silver is almost a leverage play on gold, the way that they've been. They've usually been up or down together, and silver, particularly the SLV, tends to have much wider price swings than gold for what it's worth. Crude oil prices ended up being flat for the day using the USO. Cryptocurrencies kind of remaining in a risk-off footing. We've been talking about that bounce off of 60,000. Bitcoin did trade around 70,000 over the last 48 hours, but during the equity trading session kind of rolled over along with stocks. Bitcoin's currently just above 68,500. Ethereum prices holding just above 2,000 for now. It's been bouncing off of that level for the last 12 hours or so. Both of those are down. You can see all top 10 coins here on the stock charts platform in the red today. All right, looking at the 11 S&P sectors, not a great day, but kind of a coin flip, to be honest with you, with 6 of the sectors higher, 5 of them lower. On the upside, we have utilities, real estate, and materials as your top 3 sectors. Utilities, the best performer, up 1.7%. REITs and materials both up 1.4%. On the downside, 5 of the sectors were lower. Financials, the worst. Healthcare as well. Both of those were down just over 0.6% to the downside. Technology down 0.6% as well. And tech is a big way. I mean, that's about a third of the S&P is this one sector of technology. So, it's almost like you could, different way of thinking of this table is, if you think of the font sizes represent the market cap, something like consumer staples or materials, like too small to read, and technology is going to take up a third of the vertical space. That's how big tech is compared to some of these other sectors. So a big weight around the neck of the markets here with the XLK down 0.6%. Breadth ended up being very mixed here, although generally okay. On the New York Composite Index, 61% advancers to 36% decliners. So that's about a 2-to-1 ratio. On the S&P, about the same, 60% up, 40% down. Similar reading in mid caps and small caps. So not horrible breadth, kind of more neutral to slightly positive, looking at the NYSE. All right, the Magnificent Seven and friends, these leading growth stocks. Tesla, really the only one having a pretty decent up day. Netflix bouncing higher as well, but neither of those are great charts. And as a matter of fact, I would say out of all of these charts on this list, those would probably be my 2 least favorite, would be Tesla and Netflix. And so they're both kind of having a counter trend bounce after being beaten down here for a while. Tesla had a doji candle that was on Thursday of last week. Friday, now Monday, Tuesday, 3 up days. You might call that the 3 white nights candle pattern. We'll see if tomorrow's a down day. That would be a pretty negative rotation. It's almost like a bear flag pattern when you, if you know your candle patterns. Microsoft flat for the day. On the downside, Alphabet, which I would say has been by far the strongest of this basket of stocks, has just had a rough rough week, really, essentially, right? After making a new all-time high, pushing 350, it's rotated lower, finished today just below 319. That's down 1.8%. At some point, Google starts to look like not a great chart anymore. It's actually just below a 50-day moving average, I believe. I grabbed that chart so we could look in a little more detail. Broadcom also looking questionable, down another 1% today after bouncing off of lows. And Meta really sort of stable, but not particularly strong here. So, none of the Magnificent Seven stocks really, an enjoyable technical configuration, I would say, right about now. I didn't grab a lot of breadth charts here, and the reason is because there's no real change to that story. So just to keep you informed and updated, the breadth remains quite strong, right? The breadth in this market is still very, very good. The major indexes are languishing, and I would say still very much in a consolidation phase, not because a lot of things are going down. Plenty of things are actually doing quite well. Here's the New York Stock Exchange advanced decline line, made a new all-time high again today after making new all-time highs last week. Made new all-time highs the last couple of months. And so we're seeing plenty of strength and breadth. It's just not in the big names that would really allow the S&P and the NASDAQ to flourish. If the right names were going higher, the S&P would be way above 7,000 by now, but it's not. It's not the big technology and the big growth stocks, generally speaking, that are the biggest weights in the S&P. Those aren't the ones that are breaking out, but a lot of things are. And so what this tells you is, though, even though the S&P is flat, there are plenty of stocks out there in primary uptrend. So great reminder to use scanning tools, use different routines and techniques to always be looking for stocks showing positions of strength. All right, we're going to continue on looking at the heat map here. Quick reminder, please drop your questions in the comments section on our YouTube channel. Had some great feedback, as always, recently here, and I appreciate the kind words on the show. I thank you so much for tuning in, and if anything we share here allows you to make one better decision this week, I'm happy about that very much. Please take a moment to drop a question in the comments section, and hopefully we can answer your question in Friday's mailbag episode. I'm looking at the heat map. It sort of depends on which sector you look at. If you start in the lower right corner and look at REITs and materials and utilities, those are these three sectors down here, and you ignore everything else, pretty good day, right? And what's fascinating is utilities were the number one sector. Some of these charts are absolutely ripping to the upside. NextEra Energy made a new all-time high. Now, some of these are kind of low volatility, higher dividend names. So you have to remember that, these are not designed. These are stocks not necessarily designed for huge capital appreciation. They tend to be lower, kind of slower, steady types of names, but they often have a decent income component. That's one of the best features, arguably, a lot of these. But PMW, Pinnacle West, making a new high. EIX, Edison International, making a new high today. PG&E, not making a new high, but making a new swing high. EVRG, Evergy, making a new high today. So there's a lot of really compelling charts in there, and some of these like Duke or Southern, which have not been particularly good charts, have just really ripped higher from December into January, now into February. It's almost like completely changed the character of those charts from 2025 to 2026. So if you've been ignoring the utility sector, I don't blame you. It's not been a particularly great area of the market. The relative strength has not been particularly good, but it's starting to change. And, I would never blame someone for avoiding a sector when the sector's been underperforming. That's good. I think that's doing the right thing. But continuing to ignore a sector once the relative strength improves, that's on you, right? That's the issue. That's really why we started Market Misbehavior, to help nurture good routines and good habits to not miss that next great thing, right? Charts that go exponentially higher always start with an initial rotation, what we call a change of character from distribution to accumulation. Hopefully the things we share on this show encourage you to have good routines. And I hope this is part of your daily routine to make sense of things and think about some things you might want to dig into. All right, so elsewhere, what to talk about? The financial sector looking less and less great. And I will tell you, it's a mixed bag of a lot of different things. I don't think it's one particular type of chart that's happening here. Charles Schwab, for example, is down over 7% today. This is after making a new all-time high on Monday, pushing above $106 a share for the first time in history. Now just giving back a lot of those gains and more. And the problem I have with charts like Schwab is the fact that we've had this nice uptrend phase on weaker momentum, right? Clear bearish momentum divergence. And the danger with a chart like this is we're making new highs on weaker momentum, which means at some point the price starts to rotate lower, right? There's two ways that a chart can resolve this sort of bearish momentum divergence. Way number one is we accelerate higher, we break out, and the momentum improves. So when the RSI goes back above 70, I would say that is a big thumbs up telling you resuming positive momentum. That's actually great. That tells you a lot of buyers are coming in. The other way this can resolve is what we're seeing with Schwab, which is the price goes higher, the momentum is weaker, but then eventually the price snaps lower because that weaker momentum is hinting at an issue underneath the hood. It's hinting at some distribution happening during this period, which is not readily clear when you look at the price action. Unfortunately, that's what's happening with Charles Schwab. That's not the only chart in the financial sector, I would argue, showing that kind of short-term weakness. And it goes back to things like JP Morgan and others. I mean, these aren't bad charts, but just not, like the question is, can it get above? Can it push to new highs on stronger momentum? And a lot of them are sort of holding in a holding pattern, right? Sort of circling the field, not quite ready to make a good landing there anymore. They're not horrible charts, though, right? Morgan Stanley's not a horrible chart, but it did close back below the 50-day moving average today. The momentum's not exceptionally strong, but it's not weak, but it's not strong either. And Morgan Stanley, similar, right? You have this bearish momentum divergence going into the mid-January high on weaker momentum. Now the RSI is just dead neutral. So, the financial sector generally had been much stronger in the fourth quarter. As we rotated into 2026, a lot of these names looking less strong than they were. The areas showing the biggest improvement are some of the more defensive areas like insurance companies like Aflac. That's where you're seeing these big rotations. Talk about technology here as well. Again, this is one trading day. So as always, we don't want to draw long-term conclusions by what happens on one day. But I am laser focused on semiconductor names like Micron, stocks that had really good runs that are now, pulling back after previous highs. That's okay. And that could be just part of a normal, healthy pullback within an uptrend until it isn't. And so watching key levels of support, pretty important. I think Micron's still okay, but we're pulling back pretty aggressively off of those highs. The hard drive companies, Western Digital and Seagate, these are really volatile names. They've become aggressively volatile in 2026. Both of them experienced huge Januaries, and now February, not really breaking down, but basically treading water, right? So when you have a huge rally, there's kind of two things that can happen. Either you drop quickly, which can happen, or a lot of times you'll kind of consolidate for a little bit. And that's how I would think of these charts, right? They're still in great shape. They're still, in this case, Western Digital holding a 21-day EMA. This little bar right here is an 8% swing. That's how this doesn't look like a very volatile chart because it's this nice, slow and steady uptrend. But these are big percentage swings because it's been an exponential gainer. I mean, this has been an aggressive pace on this advance from the April 25 low to where we're at now in February. So over the last couple of weeks, it's more treading water. It's holding its ground. It's not breaking down, but it's no longer, advancing at the pace that it was. And so the question is, does it hold support? Does it hold the 21-day EMA? If not, does it hold the 50-day? And I think this example here from November is what you're kind of looking for. That's an ideal situation is you pull back. Pullbacks are normal. We hit the 50-day moving average. You have this nice hammer candle, which implies a buyable dip. That's the kind of thing I'd be looking for on some of these names like STX and WDC, which have already had really good runs to the upside. What else do I want to talk about? I mean, within communication services, it's very interesting to me that you kind of have the big names, Alphabet, Meta, and Netflix. Then you kind of have everything else. Communication services is kind of a weird sector. It's the old telecom sector, like AT&T, Verizon, like the old Ma Bell kind of stocks, and mobile devices in there too, right? Like T-Mobile. Then you have the internet names like Alphabet, Meta, streaming, consider those in a second bucket. Then you have, the streaming entertainment names like Netflix, Disney, right? Comcast kind of things. Those are kind of three very different buckets. AT&T and Verizon are very defensive names, particularly AT&T, higher yielding. Both of those have had really good surges here in the last week or so. But the big internet names are the biggest weight by far. They dominate the rest on a market cap basis. And those are ones that are struggling a bit here in the short term. We grab the chart of Alphabet, which we'll look at here in a moment. All right, that's it for the heat map. And again, those defensive sectors are standing out to me. Consumer staples we didn't talk about, but today was not a particularly good day for the big box retailers, but I'm keeping an eye on food products and tobacco names in there as well. Quick shout out to Seeking Alpha, longtime friend of Market Misbehavior. You can check out more information about their premium memberships at marketmisbehavior.com/Seeking Alpha, or scan the QR code on your screen. They're doing a Valentine's Day sale this week. You can check it out. A little better deal than normal. Make sure you use my link. That'll give you a better deal than if you go to the website, and also helps me make Market Misbehavior awesome. Seeking Alpha is great. I use a number of different platforms, to be honest with you. I share with you a lot of the platforms that I use in the course of the show. Seeking Alpha is one that I use because I really like their quantitative model. I think it's well designed. I think the approach is consistent with what I've seen at big money management firms, but accessible to individual investors. And I think that's pretty awesome. I love that we live at a time when individual investors have access to some pretty cool stuff that back in the day only big institutions could afford, because you had a big research department running quantitative models. Now you can get one along with some great portfolio analytics and some good research there as well. Marketmisbehavior.com/Seeking Alpha is where you want to go, or scan the QR code that you see. And again, thanks to them for being a great partner to Market Misbehavior. All right. Looking at the daily chart of the S&P 500, we are back in the green light area. We've been kind of toying the green and the yellow lights here for the last couple months. If I had no idea how long this would be a central part of how I talk about the S&P, but I mean, it's what the market is telling you. I think, excuse me, I think we've been in a consolidation phase for a while here. You can see that the S&P is basically trading between 6,800 and 7,000 over the last 6 weeks. We've literally just been bouncing between support and resistance. This is a swing trader's paradise of just betting on short-term swings. But as a long-term investor, as a position trader, there's just not much going on at the index level. And again, that is fine if you have the opportunity to go further down in the equity space. And again, I'm not struggling to find charts that are all looking good. This is the cheat sheet that I used, my hand-drawn notes for that stock picking draft that we did on Saturday with Tom Boley and Grayson Rose. Every one of those tickers that I wrote down are pretty interesting charts. It's a lot of tickers there, right? And in all 11 sectors, I was able to find at least a couple stocks that look pretty good. So I don't think it's hard to find compelling charts, but it's a reminder that when the major indexes are basically consolidating, great opportunity to go elsewhere. And that's where I'm finding some opportunities here. So at the high index level, we are still below 7,000. No trumpet today. We are still above 6,900, which I say we're in the green light area. We're above the moving averages. As long as that holds, we're pretty good. Today was a bit of a down day, but still, very, very close to 7,000. So market's still in good shape. The momentum has just been dead sideways. From the end of November, the RSI has been almost 100% of the time between 40 and 60. That means buyers and sellers are in equilibrium. We're in agreement. We're sort of generally saying the S&P is worth about 6,900 points right about now. It's not worth a lot more than that. It's not worth a lot less than that. It's kind of right in the middle. And so the trend for now is sideways. So as always, let's be looking for actionable opportunities elsewhere. Before we do that, though, quick comments or two on other asset classes. Rates coming down today. So bonds rallied. This was after the retail sales number this morning. And so with where that came out, sort of gave investors confidence that we might have a couple more, maybe 3 rate cuts in 2026 as opposed to 2, which is what the market has been pricing in. So what's happening is bonds are rallying. 10-year yield is coming down. The dollar sign TNX which is the 10-year Treasury yield on stock charts, back below the 50-day moving average for the first time since early December. The yield curve has generally been steepening, but with rates coming down, if bonds would rally significantly here, that would mean the long end is starting to come down. And that means that the yield curve is not going to be as steep as it has been. You're seeing that just a little bit, but essentially the yield curve is flat here. This is looking at the 3-month point versus the 10-year point. You can see this has been flat since mid-December. So really the curve is basically in a general normal shape and not really steepening or flattening, kind of remaining fairly stable here. But that's something to watch. Crude oil prices, I would say, also consolidating. The word consolidation is coming up a lot as I'm looking at major things. Dollar's flat today. Crude oil basically chopping around today. I would argue crude oil is in a pennant pattern, which is when you have a big move and then you have this short-term consolidation. Higher lows and lower highs. We're sort of in a narrowing of the range. You look to see which way this breaks. If crude oil breaks out of this pattern to the upside, talk about a great tailwind for energy stocks, many of which have had really, really good runs. I like the fact that crude oil is holding the 200-day moving average. I think that's pretty important to the bull thesis for energy stocks. Alphabet, it's looking less awesome. I won't lie. And there have been things that have been going into February. My concern was, or really, through the first week in February, we're seeing new highs back here on stronger momentum. We're seeing new highs with the RSI pushing above 70. That's pretty healthy. Going back to July, we start making new 3-month highs with the RSI pushing above 70. That's healthy. That tells you there's a decent amount of demand. That tells you there's accumulation happening. As long as we keep making new highs and we're overbought when we do so, that's pretty good. But look at this most recent new high in early February, and look how the RSI did not quite get to the overbought region. That is a bearish momentum divergence. We've now seen it on the chart of Alphabet, which is by far the strongest chart in the Magnificent Seven here over the last 6 months, I would argue. Now, and this is after a choppy, gappy week last week around earnings, when we had that lower open and higher close after their earnings release, now we're kind of stalling out and rotating lower here. And today we're closing back below the 50-day moving average. That's the first close below the 50-day moving average since May of 2025. So it's been 9 months since we've closed below the 50-day. It's happening today. This is a vulnerable chart now. I would say in the short term, that 300 level is key because that's the swing low from December. RSI is right at 40. So holding 300, RSI holding 40, that means we're still okay. We're not great anymore, but we're okay. Breaking below 300, RSI breaking below 40, that would be a huge issue. I'm going to set an alert for 300 to keep an eye on that. And I would encourage you to use something like stock charts to set alerts. Really, in the modern day and age, leverage platforms like stock charts to do the heavy lifting for you. I am not great at remembering key levels and remembering to keep an eye on the chart of Alphabet. I automate the crap out of that kind of thing because it's easy for me to not have to remember it or worry about it. I use alerts heavily. Always have. Back when I was first learning about charting at Bloomberg, I used the alerts function on Bloomberg all the time. Any platform I've ever used, Optima, UpData, so many alerts are your friends. So whatever platform you're using, I use stock charts primarily now. Use the alerts for sure. Broadcom, again, nice rally up to the 50-day moving average, but now the question is there enough mo to get through the 50-day? The problem is in January, we weren't able to do that. We had a number of tests of the 50-day moving average from below. They all failed. We then broke below 320, but held the 200-day. So we're in this limbo between the 50-day and between the 200-day. One of these is going to break here pretty soon. Either Broadcom breaks above the 50-day, breaks above 360. That would be a very positive resolution to that chart. That would mean we are following through to the upside. On the downside, a break below 300, we'll call it 310. That would be a break below the 200-day moving average and below previous support. The momentum's not great. To be honest with you, the momentum's been pretty weak since mid-December, with the RSI not really getting much above 50 until this week. However, it's all about, can we get back above the 50-day moving average? We're in between the moving averages. Which of those breaks first? Let's keep an eye on that. On semiconductors, one of the semiconductor names reported earnings yesterday. Nice upswing, up 3.5% today after yesterday's report. I really love the fact that it's clearing this resistance. This is around, what, 63, 64. We retested that here in mid-January. Today, we're kind of breaking above that. Those breakouts are coming on weaker momentum. So similar to like Alphabet and other vulnerable uptrends, we've got another issue here. So we need to break out on stronger momentum. I think that's still more to prove. But for now, nice price action, nice relative strength. Let's see if the momentum can turn positive. We got a couple stocks that are pulling back after great runs higher. Coca-Cola is one. They reported earnings before the open today. Traded lower yesterday, gapped lower today. It kind of finished right in the middle of the range, but it's down about 1.5% from yesterday's close. We're out of the overbought range. Can we hold that 21-day EMA? If so, that's still a pretty good chart. Marriott, again, I'm absolutely kicking myself. Again, we got a lot of game left in the stock picking competition, but I talked about Marriott and Hilton. I was looking at these and thinking, maybe I take a shot here. But, tough to own a name like this going into an earnings release, to be honest with you. But earnings went pretty well. They reported before the open today as well. Stocks up 8.5%, making a new 52-week high. That's a great chart. The setup going into earnings was quite strong. The setup coming out of earnings, more of the same. Can it hold today's gap tomorrow? That's the question on a chart like that. We got a couple names reporting after the close. I just want to spend a moment to highlight. Gilead is one of those biotech names you want to keep an eye on. They're down about 3.4% in the after hours, down to around 142. So that's not down too much. That's down around here, 142. So we're still holding the 21-day EMA. We'll see what happens tomorrow at the open. Again, the after hours session I find is interesting. More for like an initial reaction and directional movement, but you really have to wait for tomorrow when institutions are getting more involved and it's more of a more volume, more participants. But for now, it looks like a negative reaction to earnings. It was down today going into the earnings release, down about 3%. Looks like tomorrow is going to open lower as well. And again, great chart. Holding the 21-day EMA on a pullback during a nice run is always pretty helpful. Robinhood reported after the close. It didn't look like it was doing particularly well. Yeah, we're down almost 7% to 79.70. So we're currently trading down around here. So, again, when I see charts like this all the time, and I've had a number of people ask about Coinbase and Hood and Bitcoin, they're all kind of looking similar with these big rotations lower and then this big V-shaped bottom. V-shaped bottoms are really tough to buy into at the moment because I would argue, as much as that's tempting to buy into that, this is what we would probably call as most likely a dead cat bounce. A dead cat bounce is when you have a primary downtrend. When you accelerate, at some point, some buyers somewhere start seeing this as a pretty good bargain, right? It's like having a Bed Bath and Beyond coupon. It's a 50% off coupon. It's trading up here around 150 in October, and now we're down around 885, right? We were down as much as 72, 73. So you literally have a 50% off coupon on Robinhood. So, do I take a shot? And enough people did. We had a bit of a bounce. But the problem is we're still in a downtrend. The problem is we're still making lower highs and lower lows. The problem is there's not enough signs of accumulation that give me high confidence that that's going to be a sustainable rally. It feels more like a dead cat bounce, which is a severe, quick, sudden reaction, and often before the next leg lower. And an earnings miss could fuel that. All right, with all those charts that are looking a little vulnerable here, what's looking interesting? Home Depot made a new, swing high today on a closing basis, just kind of threatening that 390 level. Closed just below that today. What I wanted to highlight here is the fact that the volume has rotated. Look at the chart of Home Depot, and this is an indicator called the Chaikin money flow at the bottom. This is an indicator called accumulation distribution. These are two volume-based indicators that Mark Chaikin created years ago. Look at the negative volume. This indicator has about a 1 month look back. And so it's looking back at the last month and basically gauging the strength in volume on up moves and down moves. And the fact that it's consistently below zero tells you we're in a period of distribution. But look at what happened about a month ago. We flipped to positive. We started breaking out. The volume indicators turning positive here. So that's telling me Home Depot now in a period of accumulation. On a price basis, we broke above the 200-day. We held it. Now we're rotating back higher. I think that's a pretty compelling setup here. Defensive sectors at the top of the list today. Watch utilities making a potential new swing high on the relative chart. Also real estate starting to hook higher here. Both of those sectors outperforming in February, as is consumer staples, which has actually been a great relative performer since the end of last year. While healthcare is still flat, the other defensive sectors may be starting to hook higher here. Within utilities, not struggling to find some pretty decent charts. This is NEE, which is more of like a renewable energy kind of play. I'm looking at wind and solar and other things, but look at this cup and handle pattern that we have from 2024 to 2025. And just in the last couple of weeks, we're breaking above that rim of the cup and pushing to the upside. Strong chart getting stronger. I would argue innocent until proven guilty. Folks, that'll do it for today. Thanks for watching Chart This with Dave Keller. I appreciate you tuning in. Please tell your friends, like the video, all those things you can do on YouTube. It helps the algorithm. It helps introduce my content to other people. And I can't tell you how much I appreciate you spreading the word anywhere you can. For now, I will say thanks for watching. Have a great evening. My name's Dave Keller with Market Misbehavior, reminding you it's always a good time to own good charts. Take care, folks.